Hello and welcome to Armanino's series, Opening the Black Box of the Paycheck Protection Program. My name is John Sweisberger. I am a partner in charge of Armanino's business outsourcing services practice. And today we're going to focus on one aspect of the new PPP program, and that is what's known as the second draw loans. And today we're specifically going to focus on what does it take to be eligible for one of those. I am joined today by my partner in the business outsourcing services practice, Jen McCabe. Jen, welcome, and tell us a little bit about these second draw loans.
Okay, so we'll start at the top. The legislation was specifically meant to target businesses who needed the money the worst. They were responding to some criticism the first time around that they hadn't done this well enough. So they wanted to target smaller businesses. So there's a restriction on number of heads. They wanted to target businesses that had seen a reduction in their sales, their gross receipts as they call it. And let's remember, this is for people who had a first draw PPP. So this particular part of the program is for people who had a loan, they spent it, and now they need a second loan. And to get a second loan, let's start going down the list. Let's say you got a first loan and you wanted a second loan. The first thing that you must show is that you had a 25% decline in your gross receipts and you compare 2020 to 2019. So you look at the period, say third quarter of 2020, and you compare it to the third quarter of 2019. And if your gross receipts have declined by more than 25%, you can check that box. And when you do the application, you are going to have to put those numbers in. You're going to have to say, third quarter, here's the receipts in 19, and here's the receipts in 20, so that they can see that you've done the math. Now, John, the cutoff is, I think, 150,000. You don't have to actually provide those numbers. Is that correct?
Well, that's correct in terms of upfront in order to apply for the loan. But if you do find yourself in a situation where your loan amount's under $150,000, you are at some point prior to applying for forgiveness going to have to put that information into the bank that demonstrates that you did in fact qualify with at least a 25% year-over-year decline. Jen, I've got one other question while I've got you here for a second. What if the business doesn't produce quarterly financials? How do you prove that?
That they're thinking about folks who do their financials annually on the kitchen table, and they're nice about it. They say, look, if it's easier for you to just show 2019 versus 2020, that works too for us. And so if you're listening and you know that you haven't closed your books, but you know in your heart of hearts that you have this 25% year-on-year decline, you might be able to just show that. It might be easier. And the other thing they say is, people say, well, what's gross receipts? It's based on the way you do your accounting and the way that you have historically done your accounting, which is interesting. So if you're a small business and you just do it on a cash basis and you file your tax returns cash basis, they have actually said it's okay to show us your bank statements quarter on quarter and just show that your gross receipts are less. So smaller businesses are really getting a lot of slack. Bigger businesses are going to have to say, look, here's my quarterly financials, and they will look at it and see if that's the way you've done your books for a while. So you don't want to change the way you do business is the message I'm putting down here. Don't screw around with your financials and suddenly do tricky stuff.
Great advice. We definitely don't want to be screwing around with things too much here. But yeah, certainly if you don't have quarterly results that you can point to, but you were 25% for the year, well, certainly somewhere in there, at least one of those quarters, you had to have a more than 25% decline. So that should be just fine. The other key part of eligibility is how many employees do you have in the business? And where in the first go around, that was a 500 employee limit. That limit is now dropped to 300. So you need to be able to meet both of these criteria in order to be able to pull a second draw loan, both the year-over-year decline and a cap of no more than 300 employees. Now, it's real important that we have a clear definition around what is an employee. An employee is anybody that you give a W-2 to, whether they're working 1 hour a week or 40 hours a week, they are counted as an employee. It is not FTEs or full-time equivalents. They go back and forth in this program. So in the first go around and in the second draw, it's the number of noses, but in the forgiveness, that's based on full-time equivalents. So it's easy to get confused on that. Just make sure that we're talking right here, just basically count noses, anybody you give a W-2 to.
Right. And it's at the time of the application. They want to know how many bodies you have in motion. And then, John, the other thing to say there is it does not include foreign employees. It includes United
Right.
States workers who are on a Form 941 or a quarterly tax return.
Exactly. You're going to have to be able to demonstrate it. Let's move on to loan amounts. And how does that get calculated now?
Well, this is cool. They haven't changed it. It's 2.5 times your average monthly payroll costs. So that means you look at your average monthly payroll costs in the last 12 months is one way they put it, which means you could use 2020 or you could use 2019 as you've got on here. Then you have to divide it by 12 and multiply it by 2.5. John, the payroll costs are payroll, gross wages, but you can't go over $100,000 a year for a person. So on a monthly basis,
on an annualized basis, correct.
Exactly. So anybody who makes more than $8,333 in a month, you've got to max it out at $8,333. So that's the one limitation, but you get to add the employer paid portion of health insurance, vision, dental, and now they've said life insurance. If the company is paying life insurance premiums on behalf of the employees, you can include that. For some people that I'm talking to, it sounds like they had a higher payroll in 2019, so they're going with that. And they are literally just repeating the amount that they applied for in the first round to keep it simple. And then talk about that 3.5 there, John. When it says NAICS 72 entities, tell me what kind of businesses those are.
That's the industrial classification code for hospitality and restaurant type of entities. So if you've got a hotel or a conference center or a restaurant chain, or you're a franchisee of a restaurant, that kind of a thing, those are the 72 entities. And for those obviously highly impacted entities, they have said, let's throw you an extra bone and make the multiplier 3.5 instead of 2.5. But it's only for people whose code starts with a 72, and you'll find that generally in the upper left corner of your tax return.
Now let me back up. So I was just saying, for some people it's cinchy to just say, I'm going to use the same amount I used on my PPP1 loan. But if you're a 72 NAICS code, you're say a restaurant or a hotel, it's going to make a lot more sense for you to use 2019 payroll, average 12 months, because it's probably higher, and to use the 3.5 multiplier. But the limiting factor here is that you have to have spent all of the PPP1 money first. Right.
By the time your second draw is dispersed, that first batch has got to be gone. Now, this really gives people a choice. This 2019 versus 2020, or starting February 1st, the prior 12 months. You could do February 1 of 20 to January 31 of 21 if you want. But basically you have your choice of these 3 different time periods, and it comes down to what are you hoping to accomplish. If generally, in most cases, if you had a year-over-year decline of 25%, you probably have fewer employees in 2020 than you had in 2019. Not always, obviously, but in general, we can make that statement, which says this: the amount that you can pull off of 2019 basis is probably higher than the amount you could pull off of a 2020 basis. So if what you're trying to do is maximize the amount of money that you get in this loan, you'd probably want to use 2019 as your basis. Conversely, that could make forgiveness quite a bit harder, particularly if you've cut your staff a lot in 2020. And so if your goal is, well, I need to be able to get through 2021 until we're kind of back on our feet with my skeleton staff, and I don't want to have a bunch of money I have to pay back, meaning I want maximum forgiveness, in that case, you're probably going to want to pick 2020 as your basis. So it's your choice depending on the needs of your business.
Right. That's important for small businesses. I talk to owners who say, I want it all forgiven. I don't want to have a loan at the end. So that's a really good point, that you could borrow based on an amount that is higher, but you might not want to end up with a loan at the end for whatever portion isn't forgiven. And remember, if you end up with, say you take a $100,000 loan and $70,000 is forgiven, you still use all $100,000 on forgivable type expenses, and you're not allowed to use it for crazy stuff, but you're allowed to use it to operate your business. You would end up, in that case, with a $30,000 loan at 1%. And you need to make that decision. You have the choice here. It's important.
How much can somebody take out, Jen?
Well, now the maximum is $2 million per entity. And since we're talking about the hospitality industry, that head count, the employee cap, is actually per location. So say you're a restaurant group or a hotel group, that nose count that John was talking about is per property. So in those cases, folks might get a number of PPP loans per location. And if that's the case, even in those cases, you add them all up, you can't have more than 4 million for the whole group, and you can't have more than 2 million per entity this time around. They've reduced the maximum amount, limiting again the size really of the businesses.
Exactly. So basically, it's we're at 20% of what it was on the first draw loans.
Mm-hmm.
And then the last thing is around the restricted entities, those that can't get these, even if they meet the eligibility requirements at the top. It was always, well, not always, but eventually became, you can't do this if you're publicly traded, meaning you have access to other capital. But now for the second draw loans, in addition to the ban on publicly traded companies, if you have an entity that is organized under China or highly affiliated with China or political lobbying firms or anybody that receives what's known as a shuttered venue grant, those people, those entities are not able to take out a second draw loan. But other than that, as long as you meet those two eligibility requirements in the top two rows of this, go for it. It's yours if you'd like it.
Yeah, I think all of that is super logical. The shuttered venue grant, the SVG thing, is the one thing here where I think people listening may need to pay attention. If you get a grant because you run a movie theater or a theater, any sort of event type thing, and you get one of those grants, you cannot get a second round PPP.
Okay, there we go. So that kind of gives you the key differences, what sort of change between these first and second draw loans. I want to leave you with this. This can be really complicated, both on the loan application side and the eligibility determination and the calculation of the loan amount, but also on the back end, the forgiveness, as we know, has been very complicated, and it's not going to get any easier either. So we can absolutely help you with either the front end or back end of this if you'd like. All you need to do is pretty much gather the reports based on the documentation list we send you, send them to us, we take care of the rest. If you're interested in that, all the details can be found on the landing page that you see here on the right, which is learn.armaninollp.com/SBA. And of course, we have hundreds and hundreds of questions around the PPP program in a searchable library at the link that you see at the bottom of the slide. Jen, thank you very much. Everybody, join us again for our next video where we will focus on the new first draw loans. Take care, everybody.